Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia. In today's episode, we're going to explore a topic that sits at the intersection of real estate investing and macroeconomics: how REITs perform across macro cycles. For many investors, real estate investment trusts, or REITs, are viewed primarily as income producing investments. They're often associated with attractive dividend yields, stable cash flows, and exposure to commercial and residential property markets. While those characteristics are certainly important, they only tell part of the story. To truly understand REIT performance, investors need to take a step back and look at the bigger picture. They need to understand REITs' macro cycles and learn how to evaluate real estate through a macro lens. The reality is that REIT performance is heavily influenced by the broader economic environment. Economic growth, inflation, employment trends, consumer spending, central bank policies, interest rates, and credit conditions all play critical roles in determining how different real estate sectors perform. Today, we're going to break down the major stages of the economic cycle and examine how various REIT sectors tend to respond during each phase. Let's begin with the basics. REITs are companies that own, operate, manage, or finance income producing real estate. They provide investors with an opportunity to gain exposure to real estate without directly purchasing and managing physical properties. The REIT universe is incredibly diverse. It includes residential apartment communities, office buildings, retail shopping centers, industrial warehouses, healthcare facilities, hotels, self-storage units, data centers, and telecommunications infrastructure, such as cell towers. One of the most important lessons investors can learn is that these sectors do not perform identically. Different property types respond differently to changing economic conditions, which is why understanding REITs' macro cycles can be such a powerful investment advantage. Let's start with the expansion phase of the economic cycle. Economic expansions are generally characterized by rising GDP growth, improving employment conditions, increasing consumer spending, growing business investment, and expanding corporate profits. These conditions often create a favorable environment for many types of real estate. As businesses grow, they require additional office space, warehouse capacity, logistics facilities, and commercial properties. Consumers with stronger incomes tend to spend more money, supporting retail businesses and driving demand for shopping centers. Strong labor markets often contribute to increased household formation, boosting demand for residential housing and apartment rentals. Industrial REITs frequently perform particularly well during economic expansions. As manufacturing activity increases and e-commerce continues to grow, businesses often require additional warehouse and distribution space. Residential REITs may also benefit as employment growth supports rental demand. In many cases, apartment owners can increase rents while maintaining high occupancy levels. Retail REITs can see improved tenant performance when consumer spending remains strong, while hospitality and hotel REITs may experience increased travel activity from both business and leisure customers. One of the defining characteristics of expansionary periods is the ability of landlords to exercise pricing power. When vacancy rates decline and demand exceeds supply, property owners often gain the ability to increase rents. This combination of rising rental income and healthy occupancy levels can support both earnings growth and property valuations. This is one of the clearest examples of how REITs' macro cycles influence investment performance. However, economic expansions don't last forever. As growth continues and economies mature, inflationary pressures often begin to emerge. Labor markets tighten, wages increase, and demand across the economy may start exceeding available supply. This often marks the transition toward the late cycle phase of the economy. For investors examining real estate through a macro lens, this stage requires a more nuanced approach. Although economic activity may remain strong, rising inflation frequently prompts central banks to tighten monetary policy. Interest rates begin moving higher as policymakers attempt to prevent the economy from overheating. For REITs, this introduces a new set of challenges. Many REITs utilize debt financing to acquire, develop, and manage properties. As interest rates rise, borrowing costs increase. Higher financing costs can reduce profitability and potentially slow future expansion plans. In addition, rising bond yields create competition for investment capital. Income-focused investors who previously favored REITs may become attracted to higher-yielding fixed-income alternatives. Yet it's important not to oversimplify the relationship between REITs and interest rates. Not all REITs respond the same way. High-quality REITs with strong balance sheets, manageable debt levels, high occupancy rates, and inflation-linked lease structures may continue performing relatively well even as rates rise. In fact, moderate interest rate increases driven by healthy economic growth are often less problematic than many investors assume. The broader economic context matters. This is why investors who evaluate real estate through a macro lens focus not only on interest rates themselves, but also on why rates are moving. Now, let's turn our attention to inflation, one of the most discussed topics in modern investing. Many investors view real estate as a potential inflation hedge. In certain situations, this view is justified. Real estate is a tangible asset, and many property owners possess the ability to adjust rental rates over time. When inflation increases, certain property sectors can pass higher costs onto tenants through rent increases. Apartment REITs are often cited as a strong example because lease terms are typically short, allowing rents to adjust relatively quickly. Self-storage REITs also possess significant pricing flexibility, enabling operators to respond to changing market conditions. Hotels represent another interesting case because room rates can be adjusted daily based on demand. Industrial properties may also benefit if strong tenant demand allows landlords to negotiate higher lease rates during renewal periods. However, inflation is not universally positive for REITs. If inflation becomes excessive and central banks respond with aggressive interest rate hikes, financing costs can rise substantially. In those situations, rental growth may not fully offset higher borrowing expenses. Understanding this balance is critical when studying REITs' macro cycles. Successful investors recognize that inflation cannot be viewed in isolation. Instead, inflation must be evaluated alongside economic growth, monetary policy, financing conditions, and tenant demand. Next, let's discuss recessions and economic contractions. Recessions are often periods of heightened uncertainty for investors. Economic output slows, unemployment rises, consumer spending weakens, and businesses become more cautious about expansion. These conditions can create significant challenges for certain REIT sectors. Hospitality REITs are often among the most economically sensitive. Business travel declines, vacation spending falls, and hotel occupancy rates can drop rapidly. Retail REITs may experience pressure as consumers reduce discretionary purchases. Office REITs can face challenges if businesses delay expansion plans, reduce hiring activity, or downsize their real estate footprints. Yet one of the most important insights from examining REITs' macro cycles is that not every sector suffers equally during downturns. Healthcare REITs often demonstrate relative resilience because healthcare demand remains essential regardless of economic conditions. Self-storage REITs have historically displayed surprising stability due to life events such as relocation, downsizing, divorce, business restructuring, and other transitions that continue even during recessions. Residential REITs may also maintain relatively strong occupancy levels, particularly in markets where housing supply remains constrained. The key takeaway is that real estate should never be viewed as a single homogeneous asset class. Sector selection becomes increasingly important during periods of economic stress. Now, let's move into the recovery phase. Historically, some of the strongest opportunities in REIT investing have emerged during economic recoveries. Recoveries are characterized by improving employment trends, rising consumer confidence, stabilizing credit conditions, and increasing business activity. As economic conditions improve, property fundamentals often begin strengthening. Occupancy rates recover. Rental growth resumes. Property transactions increase. Access to financing improves. Importantly, financial markets tend to be forward-looking. REIT prices often begin recovering before economic data fully confirms the improvement. Investors who understand real estate through a macro lens may be able to identify these turning points before they become widely recognized by the broader market. This can create opportunities for investors willing to act when sentiment remains cautious, but fundamentals are beginning to improve. Of course, No discussion about REITs macro cycles would be complete without examining interest rates in greater detail. Interest rates influence virtually every aspect of REIT performance. They affect borrowing costs. They influence property valuations. They impact investor sentiment. They alter relative yield attractiveness compared to bonds. And they shape overall capital allocation decisions. When rates decline, financing becomes cheaper, acquisitions become more attractive, and yield seeking investors often move toward REITs. When rates rise, the opposite pressures may emerge. Yet again, context matters. A moderate increase in rates caused by strong economic growth may have a very different impact than a sharp increase driven by persistent inflation concerns. This is why macroeconomic analysis remains so valuable. Rather than reacting to individual headlines, investors can focus on the broader forces shaping the real estate landscape. For long-term investors, diversification across multiple REIT sectors remains one of the most effective strategies for navigating different macro environments. Growth-oriented sectors may include data centers, industrial logistics facilities, and telecommunications infrastructure. Defensive sectors may include healthcare, residential housing, and self-storage. More cyclical opportunities may include retail properties, hotels, and select office assets. Combining these exposures can help create a portfolio capable of navigating various stages of the economic cycle. Ultimately, understanding REITs macro cycles allows investors to move beyond simple dividend analysis and develop a more comprehensive investment framework. By viewing real estate through a macro lens, investors can better understand how economic growth, inflation, interest rates, employment trends, and credit conditions influence different property sectors. That broader perspective can help improve decision-making, identify opportunities, manage risk, and build more resilient portfolios over time. Before we wrap up today's episode, I'd like to share two valuable resources for traders and investors looking to deepen their understanding of markets, macroeconomics, and investing. If you're looking for a world-class, cutting-edge, and user-friendly trading platform designed to help you navigate today's financial markets, visit crystalbellmarkets.com/platform and explore the tools available to support your trading and investment journey. And if you enjoy educational content covering trading, investing, macroeconomics, and financial markets, be sure to check out the Crystal Ball Markets podcast at rss.com/podcast/crystalballmarkets. It's designed to be beginner-friendly while still delivering valuable insights for investors seeking to better understand market cycles and investment opportunities. Thank you for joining me for this episode of Financial Market Insights for Traders. I'm Sophia, and I look forward to speaking with you again in our next episode.